Welcome to your custom deep dive. Today we're unpacking a highly confidential global market intelligence report dated May 28, 2026.
Right. And our mission today is to decode this massive bifurcation happening in global capital right now.
Exactly. We're seeing this unstoppable AI supercycle that is completely defying the gravity of, a stagflationary global economy. I mean, the S&P 500 has breached 7,500.
Yeah, and AI giants like Micron are hitting that $1 trillion valuation.
It's wild. But underneath that extreme equity exuberance, you have the 10-year Treasury yield stubbornly anchored near 4.5%.
Because of sticky inflation, exactly. The market feels invincible right now.
Right, but to understand how fragile that invincibility actually is, we have to look at what's currently absorbing the world's capital.
Investors are basically blindly chasing tech infrastructure.
And that is setting us up for a massive liquidity vacuum, specifically the upcoming SpaceX IPO.
Oh, absolutely. The scale of this offering is just unprecedented. I mean, we are looking at a $1.75 to $2 trillion valuation.
Which is staggering.
Right. With SpaceX aiming to extract $75 billion from public markets by mid-June. That is a massive immediate drain on available capital.
Well, wait, I have to push back on that a little bit. $75 billion is definitely massive for a single IPO, sure. But the entire U.S. stock market is worth well over $40 trillion.
Yeah, that's true.
So how does one IPO create a systemic liquidity vacuum? It just seems like a drop in the ocean.
Well, because it's not pulling from the entire ocean. It's pulling highly concentrated smart money.
Ah, I see.
When a generational asset like SpaceX goes public, institutional investors desperately want an allocation. So to free up $75 billion in cash to buy in, they have to liquidate their other tech holdings.
Oh, wow. So forced selling.
Exactly. That forced selling creates a cascading effect across the tech sector. It drains the specific pool of capital that's currently propping up this whole AI supercycle.
Right. It's like a high-stakes game of musical chairs. Everyone's happily dancing to the AI music. But what happens when the SpaceX IPO suddenly yanks $75 billion worth of chairs from the room?
Someone is left standing. And we're actually already seeing the side effects of institutions stockpiling cash for this.
Yeah, look at Bitcoin. It's supposed to be an inflation hedge, but right now it's just, chopping sideways at the $75,000 level.
Right, because that 75,000 mark is the options max pain level.
Which means what exactly for the liquidity vacuum?
Well, since institutions are keeping their powder dry for tech, there's no real new money flowing into digital assets.
Got it.
So instead, options dealers are constantly buying and selling the underlying asset to hedge their massive option contracts at that strike price.
So that mechanical hedging physically traps Bitcoin in a tight range.
Exactly. It's effectively acting as a liquidity sponge, banking up capital to fund this mega-cap tech rotation rather than responding to macroeconomic inflation.
But that SpaceX liquidity drain wouldn't be fatal if the broader macroeconomic picture was actually stable.
Which it's not. The problem is the market stability rests on a completely fabricated geopolitical narrative right now.
Right. Equities are just assuming global conflicts will neatly resolve, energy costs will drop, and the economy will be saved. I mean, look at WTI crude.
Oh yeah, it just plunged to $88.50 a barrel.
And that was based entirely on unconfirmed Iranian state television reports suggesting an imminent peace agreement?
Right, while simultaneously the U.S. is still actively conducting military strikes.
Exactly. The White House has publicly called those peace reports a complete fabrication. It's like ignoring a blazing kitchen fire because you found a coupon for a fire extinguisher.
That's a great way to put it.
Which raises the question, why is Wall Street aggressively buying fake news? If they know the strikes are happening, buying the peace rumor just feels, desperate.
Desperate is exactly the right word. Traders mechanically need lower oil prices.
To reduce headline inflation.
Exactly. Which is the only way to justify future interest rate cuts under the newly sworn-in Fed chair, Kevin Warsh.
Ah, so they are pricing in a flawless Goldilocks reality to sustain the tech rally.
Yeah, completely and willfully ignoring actual physical supply chain stress.
And if you want to see the real physical reality, look at copper. On the COMEX exchange in New York, copper currently commands a massive $500 premium over London prices.
Which is a huge tell.
Right, it's like a grocery store right before a hurricane. The broader stock market is looking at the sunny sky outside, but the copper traders are inside aggressively clearing the shelves of bottled water.
Yeah, they are actively hoarding U.S. physical inventory because they know the storm, which is potential 2027 import tariffs, is coming.
Right, they see it.
That premium tells us the physical markets are screaming about a global supply squeeze, even as equities price in perfect harmony.
Right.
For anyone holding mega-cap tech right now, this disconnect between paper narratives and physical realities is a massive blind spot.
Which leaves you, the listener, with something to think about long after this deep dive ends. The report outlines a really contrarian rug pull scenario.
Yeah, the worst-case setup.
Exactly. What happens to your portfolio if the SpaceX IPO hits on the exact same day that the fake oil peace treaty completely unravels?
It would be brutal.
Think about the math here. Oil violently gaps up to $115 a barrel, inflation spikes, and Fed Chair Warsh is forced to actually hike rates, completely vaporizing any hope of a cut.
Right, and if algorithmic selling takes over in that ensuing panic, this report suggests physical gold might be the only true safe haven left standing.
Yeah, reversing its recent UBS downgrade to surge past $5,000. It's definitely something to watch. Thanks for joining us on this deep dive, and we'll see you next time.